Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, we are back in sell-off mode.
We certainly are. Stocks, long-dated bonds, and the dollar.
It's ugly out there, so let's get to the biggest stories right now in the more than $15 trillion global ETF industry. And we start with the S&P 500 hitting a session low, down nearly 3% as markets widely sell off to start this week. Investors currently concerned after President Trump attacks Fed Chair Jerome Powell once again.
And amid this volatility, we speak in just a moment to investing legend Victor Haghani in an exclusive interview.
And we will also speak to Vanguard's Rebecca Venter on the most recent launch of their active fixed income ETF. All that and more coming up. But as always, we have Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, Scarlett, ETF investors for the first time looking a little nervous. Every week, no matter what the market's doing, I'm showing you how ETF investors are buying U.S. equities like no big deal. But this week, starting to see something different. Look at this. This is short-term treasuries, short-term treasuries, short-term treasuries, right? Cash-like ETFs dominating the leaderboard. Now, there's VU. Again, it'll probably take, a nuclear war to get VU flows to stop. But outside of that, that's really it. It's almost a clean sweep of treasuries, a little more equity down here. But this is reversed. It used to be 4 or 5 equities and 1 or 2 treasuries. So that's something to watch. Let's look at the outflows, and you'll see that there's equity ETFs on the top. 5 out of IE, that's a lot of money, and $3 billion out of the Qs. If you added up U.S. equity ETFs, net $4 billion for the week. First time of net outflows in a long time. So something to watch there. That said, you have treasuries out here too, but net movement into treasuries out of equities. And let's look at an index that I affectionately call the safety dance index, which is basically a look at gold ETFs, treasury ETFs, and low vol ETFs. These are safe haven areas you go when you're nervous. Well, if you add those together, they are having one heck of a month here. That's $18 billion so far in April. April's got some time left, so it's possible we see a record in the movement into safe haven assets. And you can see 2020, we're already beyond 2020. 2022 was really bad, so we got this 1 month here that it still has to beat. So second or third worst so far. So it's just 1 week, Katie, but this is the first sign of some nerves from that sort of Vanguard bid.
Eric, thank you. I actually understood the reference, the safety dance reference.
That was pretty impressive.
Pretty big for me. We're starting off on a good note, so let's keep it going now with Victor Haghani. He is founder and CIO of Elm Wealth. He's also the co-author of the book, The Missing Billionaires, A Guide to Better Financial Decisions. And he is also a co-founding partner of Long-Term Capital Management. So quite the resume. Victor, it's great to see you in person.
Thank you. Great to be here.
So we're going to talk specifically about ETFs, but I want to start broadly about this market because, as Eric mentioned, we're starting to see some nervousness creep into the ETF flows. Up until really this point, it had just been this consistent bid to buy the dip. But now folks are really wondering, is there a dip to buy, or do we have much more pain to go? And I'm curious where you fall.
Predicting the market in the short term is really, really difficult, maybe impossible. So I think the idea in thinking about where to be in your asset allocation is to come in and say what should drive your asset allocation. And ultimately, it's 2 things. It's the expected reward for owning equities and the risk. So let's think about where does expected return sit right now. For U.S. equities, it's pretty well agreed among analysts that expected returns for long-term holding of U.S. equities is pretty low relative to safe assets of TIPS or U.S. government bonds. And it's been that way for a while. We have a really high price-earnings ratio, whether spot or cyclically adjusted. And TIPS are offering a pretty good yield. Now, how safe they are is another question that we could spend a whole chat about. And then, no matter how you look at it, we're in a very volatile environment now. So risk is high. That means you want less exposure, right? And returns are relatively low. So I think it makes sense to be pretty underweight U.S. equities without even thinking about where's the market going to go next week. Just as a sensible asset allocation, underweight U.S. equities makes sense. I think non-U.S. equities look different. I think a more neutral weighting there makes sense because the expected return is there. The risk is high, but the expected return is there, at least in the long term.
So underweight U.S. equities, and this is only on speculation that President Trump might push something at the Fed. If he were to actually fire Jay Powell, what would that mean in terms of the re-rating of U.S. equities and other U.S. assets?
Okay, so first of all, when I say be underweight U.S. equities, I'm saying be underweight U.S. equities thinking about the long term, nothing to do with what's in the news right now. It's just what are the earnings you get, what are the dividends for the long term relative to tips. If something like that happens, we're going to continue to be in this high risk state. So meaning also equities look less good when we're in a high risk state. And it could be pretty nasty for the bond market. So all of a sudden, if we see interest rates up higher, then equities would be offering an even lower return relative to the safe assets or safer assets. And and that would also certainly be consistent with being underweight equities. So if you think that might happen, and the market clearly does, and analysts clearly do worry about this conflict, it also is. It also supports the idea of being underweight equities right now in this environment. I think the key thing is to have a framework and a plan. So when things change, you have to buy U.S. equities again. You can't, being underweight is for these conditions of low expected return, high risk, be underweight. But when risk settles down again, which it will at some point,
right.
or maybe interest rates go a lot lower, it might be a time to increase exposures again. And that will come for sure. You want to be in equities in the long term, but you want to have the right amount based on expected return and risk.
So that all makes sense, and I think the professional investors are with you. I think when you look at the RIA world, I think a lot of them are completely accepting they cannot market time. So when you said risk will settle and U.S. equities will come back, then it's time to get in. I think most people are like, I cannot time the market. And S&P is still up, even with today, since it was supposed to be Black Monday like 2 weeks ago. And it's hard to time these things. And I think, what do you say to somebody who doesn't really want to put their money in cash, or especially overseas, where they feel like, where's the growth? I'd rather be in these juggernaut U.S. companies that are exciting and innovative.
Yeah, I would say that, first of all, there's no such thing as passive asset allocation. We can have passive stock investing, invest in VTI or SPY, where you're owning the market cap weighted portfolio of stocks. But when it comes to asset allocation, it's always an active decision. How much equities do you want? How much relatively safe assets do you want? And so for somebody who says, I can't move my asset allocation, I would say, well, how did you even get there in the first place? It had to be based on some expected return and risk. But I think RIAs are having a really tough time with their clients, especially because there's so much unrealized gains in people's taxable accounts. So it's like, I think you should the advisor says to the client, I think you should lighten up a little bit. And the client is like, but this has been working so well, and I have so much gains, and I don't want to pay all that tax, so I don't want to move much. But it makes sense to be updating your portfolio with the conditions that exist.
Absolutely. And I do want to check in on this market just once again, because the S&P 500, we're not quite at session lows, but we're down 2.8%. We know it has been a very volatile couple of weeks, not just in the equity market, but in the fixed income market as well. I'm curious to get your perspective, though. Have you seen any signs of disorder? There are some fears that turn on and off about market functioning. And from where you're sitting, do you have any of those concerns?
I think in the short term, we can get different kinds of dysfunction. I mean, clearly, post financial crisis of 08, 09, a lot of intermediaries, the banks and investment banks that would make markets with their own capital have pulled back from that. So a lot more of our liquidity and market making is coming from proprietary trading houses. And, I think that, we can get, I think the market does have the potential to be more gappy than it has been in the longer term past. So, I mean, there was never as big a gap as we saw in 1987, in October of 87, when I was, I was 25 then. And it was like, wait, this doesn't happen often, does it? But I think, in these markets, yes, I think that we do have the potential to gap around because there's not so much capital that's sitting there, offering these buffers.
In these markets, what qualifies as a safe haven right now? Because longer dated treasuries are plunging.
In some ways, there's when we're learning finance at university, it's like, oh, the risk-free asset. We're always hearing about the risk-free asset. There is no risk-free asset. U.S. treasuries are not risk-free. For one thing, that long-term treasuries are trading way above are sort of indicating that they have credit risk in them. We have CDSs trading at 0.5% for 5-year treasuries and so on. So there is nothing that is risk-free, but I would say that treasuries are lower risk than equities still. So we can make our investment decisions even when we don't have a risk-free asset. It's a question of a riskier asset and a less risky asset. But I don't think there is anything that is truly risk-free. But I think U.S. treasuries are pretty low risk in terms of credit risk. I think that, at the end of the day, we can print the money to pay them off. And there's inflation risk, but I think restructuring risk is very low with U.S. treasuries.
Right, so lower risk, not quite risk-free, but lower risk. Victor, you're sticking with us. We have much more ahead on ETF IQ. We'll be right back. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with emerging market bonds. EMB is the ticker you want to keep an eye on because we've seen some pretty massive outflows on a monthly basis. So you can see that so far in April, on track for the biggest monthly withdrawal since October 2023. So a lot of nervousness coming through in EM bonds. I also want to talk about a different type of bonds. We're talking about private credit as measured through PRIV. This is the State Street product. It launched in late February, and it's seen absolutely no interest. 2 net days of inflows since launch. Not really much movement to speak of in either direction, but we're going to continue to keep an eye on that one. But I did want to end with Elm because Victor Haghani is still with us. This is their ETF that was converted from a private fund that was started in 2011. It became an ETF this past February. This is an interesting one, Scarlett. So it's primarily global equities. 75% global equities is the baseline, 25% in fixed income, but we know that that can change around a bit.
All right, so let's bring in Victor right now. Victor Haghani is co-founding partner of Long-Term Capital Management, currently founder and CIO of Elm Wealth. Thank you so much for staying with us.
Thanks.
So let's talk about the Elm ETF. What problem does packaging it in this wrapper solve, and why did you decide to launch now?
Great. So first of all, the problem that we're trying to solve is that we talk to people about dynamic asset allocation a lot. In fact, dynamic index investing is what we do because we use index funds for the allocation, low-cost index funds. And when we talk to people about it, we say, your asset allocation should change based on expected return and risk and how those are changing over time. And when I say expected return, I mean expected excess return of equities relative to safe assets. So it makes sense that your asset allocation should move around because those things move around. And people really like the sound of that when we talk to them about it, but they say, isn't that really tax inefficient? Like, it means, you're trying to buy low, sell high, or over time the equity market is drifting up. And then when I need to do a rebalance, I'm going to get these capital gains. Maybe it's better if I just do a buy and hold and never really need to change my asset allocation, but then I don't pay capital gains taxes. And the ETF structure, as we know, is very tax efficient because redemptions and creations are done in kind. So securities come in and they go out, and that makes it much easier to manage capital gains. So we hope over time that there'll be little or no realized capital gains that investors will have to bear, so they can invest in this and get the benefit of a dynamic asset allocation, a sensible rules-based and low-fee dynamic asset allocation in a really tax-efficient package, get in and out anytime they want. All the things in there are really liquid, so the market makers are like, we'll give any amount of liquidity because we can buy and sell the underlying so easily.
I remember interviewing you for my book on Jack Bogle, and I always thought it was interesting. Here's somebody from Long-Term Capital Management who's now kind of a Boglehead. The funds you have in here are dirt cheap. Like, you could tell you're a very good ETF selector, probably all-in fee of like 6 bips. Can you talk about that a little bit? Did that experience at LTCM sort of help you on this evolution over to sort of low-cost ETFs?
Absolutely, yeah. And it's true. I think that I am one of those people that's done a bit of a 180 over my career. The LTCM experience that that really didn't get reported on that much, in the whole melee of the thing, is like just taking me as an example. That I had so much invested in LTCM of my own family's savings, of my own compensation over the years of working at Solomon Brothers and then there, and I just realized that I hadn't really been thinking clearly or deeply about my own personal investing. And imagine you come to Wall Street, you turn up, you do this whole training class, you learn about bond math and stock dividends and all this stuff, but nobody ever talks to you about what do you do with what they pay you. Like nobody, it was bizarre. There's no personal finance training as part of the Wall Street education. So it was really post LTCM when I decided to take a break that I really started to think about how to invest for my family. And I think that I went down the complete wrong path to begin with. I looked at David Swensen at Yale, and I looked at my friends and what everybody was doing, and I started to become a little mini David Swensen thing, trying to invest in private equity and hedge funds and all of this. And then eventually, after 4 or 5 years, I woke up, came to my senses, and was like, I've got to be an index fund investor. And then it was like, okay, if I want to be an index fund investor, there's still these questions about which ones do you buy, how much equity, how much fixed income, and then that eventually turned into Elm, which was how I started investing the way that we invested Elm, and then eventually we started to get friends and family, and then more friends to invest.
So it's a very organic process, to say the least.
Yeah.
Victor, really a pleasure to have you on today. Victor Haghani of Elm Wealth joining us, and be sure to check out his book, The Missing Billionaires, A Guide to Better Financial Decisions. Coming up on ETF IQ, we're going to drill down into fixed income with Rebecca Venter of Vanguard next.
And speaking of Vanguard, I recently sat down with CEO Salim Ramji and asked him whether he thinks that U.S. exceptionalism has peaked. Here's what he had to say.
Clients always need to be balanced, and we've been saying that for decades, in terms of the right mix between U.S., international, the right mix between stocks and bonds. So we're always advising clients to run a balanced portfolio if it's aligned to kind of their financial goals. But when you just look at the underlying innovation kind of in the economy, and you look at the underlying kind of growth over decades, across the United States. We're certainly seeing it in our flows, but we're seeing it in our clients' behaviors and in our own team's investment beliefs.
This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas is taking a look at today's drill down, where we focus on one ETF. Eric, what you got?
Katie, today we are looking at Vanguard's active short duration bond ETF. Vanguard has been going wild issuing bond ETFs for the past 5 years. I don't think they put anything else out other than fixed income, and a lot of them are active. This is one of them. Ultra short, not too complicated. Nothing with Vanguard is. Active charges 15 bips, pretty cheap for active. That's about tied with the cheapest in the category, and it just came out. Let's look at the breakdown of the portfolio. And you can see here it's going to be half government, half corporate. And the duration is going to be about 2.5 years. It's aiming to basically give you something pretty safe, but trying to eke out a little more return than just the benchmark of Treasury. So let's look at the return of this ETF versus its competitors. I think it's going to compete against JPST and NEAR. That's JPM and BlackRock. Shy, I put in, that's 1 to 3 year Treasuries. That's the boring one. You kind of have to beat that too if you're going to make the case. So it's really early. They're all in the same ballpark here. That return will help, but the low fee and Vanguard name, it probably won't start for assets, Katie.
All right, Eric, thank you. And let's keep the conversation going with Rebecca Venter. She is fixed income product manager over at Vanguard, joining us now. Great to see you in person.
Thank you. Thanks so much for having me.
So as Eric said, Vanguard has gone wild with its fixed income launches over the past couple of years. It really feels like you've ramped up the product lineup. And I mean, looking specifically at this fund, what hole did it fill when you take a look at the lineup as a holistic sort of sense?
Well, first, I think one of the major trends you're seeing, as you've already called out, is ETFs. A lot of what we've launched recently has been ETFs. by the second quarter, we will have hopefully launched 9 new fixed income ETFs just this year. So first, this product really gives us an active short duration ETF where we didn't have one in our lineup before. We also are filling a little bit of a gap in the short duration space for something that's a little bit broader and more flexible within active. So historically, we've had a little bit more of a credit-focused short duration fund, more of a rates active fund. We're really bringing it together with a broad market short duration ETF that has a little more juice. It can go a little bit more into the high yield space. We're kind of shooting for a little more, broad active in this ETF.
How do you envision this ETF fitting in with the rest of your portfolio of fixed income products?
So we now have this will be our fourth active ETF on the taxable side. We've got an ultra short ETF, that was our first. We've got a core and a core plus ETF. This can be a tool for really a number of investors. Pretty much any investor could use this in their portfolio, but it is a way that you can kind of use it as a tool to manage your duration in your portfolio. So maybe you're investing in core plus, our VPLS ETF. Maybe you want to bring down your duration, still keep it active, and you use VSDB. It's also just a way for investors to get less volatility in their portfolio, liquidity, but still really attractive yield and total return.
Do you guys obviously you own passive pretty much. When you're out there talking about this, do you have to overcome the fact that everyone thinks you're passive and actually make a case against it? How does that work with people who just assume like, hey, shouldn't I buy BSV instead?
We do have that conversation where a lot of investors are surprised to know that we've been in active for quite some time. So we actually started on the fixed income side in active with active muni funds that we started managing in-house in the late 70s. Some people are surprised to hear that. So we do definitely have that conversation, but from our perspective, it's not either or, active or passive. We see investors use them together in their portfolio. Some investors prefer one or the other. So we really just have a conversation around what are you trying to do in your portfolio? Do you believe in active? And we really just want to have the best product possible on the active and passive side for our investors.
All right, Rebecca, that's a good place to leave it. Really appreciate you stopping by the studio. That is Rebecca Venter of Vanguard. And you can read about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. Meanwhile, a quick check on these markets, Scarlett, because the S&P 500 off its worst levels of the session, but it's really not saying much because the S&P 500, as measured by SPY, down 2.8% right now.
Yeah, but it's worth mentioning that we have fairly thin trading with a lot of markets closed today because of an observance of Easter Sunday. So perhaps that lack of volume is exaggerating some moves.
Yeah, we'll see if the bulls come out to play tomorrow. You can see they're finding a home in gold right now, a haven bid working its way through GLD. Now that does it for Bloomberg ETF IQ, the TV show. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.